software stocks, some of the hottest stocks on the entire market right now, and talk about the ETFs that track them and ways that people can trade around these, get exposure, use leverage, other items like that. Software is a fascinating category right now. And John, you are an expert on this. We've done some spaces where you've really gone into depth as to how these stocks are able to rapidly grow and even at all-time highs here, continue to expand really because of that potential to rapidly expand without debt, rack up that revenue. So going to turn it over to you right off the bat if you want to give a quick brief intro on yourself and then jump into this world of software investing. Let's get started.
Yeah, so I'm John Tinsman. I'm the founder and CEO of AOT Invest. I'm the fund manager to the SOFL ETF, which is the 2X daily software platform ETF, and then also the AOTG ETF. The AOT Growth and Innovation ETF is the full name. So happy to be here today. You know, I came from the world of market making before this. So I was an institutional market maker in Chicago and studied economics at Northwestern and University of Oxford. So I've been doing investing for a long time, right? And when I was at Northwestern and Oxford, a lot of times you got told like you can't outperform the index, you can't you can't whatever do that well in the long run if you just buy the index. And I thought which was really interesting because I've been doing this for a long time is I was buying the companies like Microsoft and Visa and Google. And you guys know, like if you had bought these 5 years ago, 10 years ago, 20 years ago, the longer back you bought them, the better you did. And you did beat the index a lot. So I started to come up with some theories about like, why is that? Like what's up with this group of companies that consistently outperforms the market in the long term? And I really drew it back to low marginal cost, which is the cost to produce one additional unit. So software, like when you have one additional unit of Microsoft Excel, it costs nothing to make one unit. So scaling the business is basically free. If the growth is there and there's demand, basically like it can, the new sales come 100% profit margin. So it kind of totally skews the risk reward dynamics. I mean, you can think about a traditional company like Boeing, and for them to scale the business, like they have to build new factories, they need to increase their supply chain. It's funded by debt. It's extremely risky. And a lot of times they actually shrink their margins or lose money on the growth. So software is the exact opposite. The growth comes at very high profit margins. And we've seen this story play out again and again and again, where basically people build this software in the US, they sell it, they're really successful. Everybody says, well, how much more successful can they possibly get? You know, the law of diminishing returns of a big company. And then they go and sell it across the rest of the world for 100% profit margins. So I think this is one of the most exciting sectors, you know, ever in the history of investing. And now with artificial intelligence, you know, I think it's speeding up innovation and lowering software development costs. So it's only going to get more exciting from here, in my opinion.
Fully agree. It's exciting times. Paper, I feel like you have a very strong grasp. You obviously trade a lot of these names. Talk to me about where you see opportunity right now in this software.
Gav,
oh yeah, or Evan,
I do also know Paper Gains is an expert in the software space as well. I feel like we know Paper Gains the trader. Is there maybe a little bit of a different history that we could hear about some of the software stuff? You don't have to. You don't have to. I would love to hear it, but I know you have some other thoughts too.
I guess you're going like different avenues here. Well, so my background, so I live in Silicon Valley, so I come from enterprise IT, which is probably where he's getting what he's getting at. So funny enough, I guess, you know, coming from the Valley, it's like part of my story is that a lot of the companies that we trade today, quite frankly, like most of them were my customers coming from the Valley, coming from enterprise IT. And I say customers because in the enterprise, I was what we call like an account manager, or like I would basically build solutions, software, like full stack solutions. Like here's the business problem, and then I did it to try to make it as simple as possible. Is like I would have a business solution, and we would take software, hardware, technology, and put everything together to fix the business solution. So knowing and being at the bleeding edge of technology, combining both software and hardware to fix to solve a real world solution, that was what I did. for for many, many, many years. And so coming into the world of stocks, it's funny, you know, like Robinhood, DoorDash, Uber, CrowdStrike, Snowflake. These are all my largest customers. DoorDash, like these were my customers. So getting to trade them every day, that's pretty cool, right? So so yeah, I mean, having the familiarity with these customers and knowing, I guess early on, like who is on the bleeding edge of their space, who's really beating who's really actually eating whose lunch, was kind of my thing early on, at least in the stock space. At least I like to think so. But yeah, that's a little bit of my background. I think today, in today's world, like we can look across both, let's say, semis and the software space as a whole. Software, as you know, not a lot of people know like SPY, QQQ, even SMH as an index, but not many people know about IGV as an index, which is the software ETF. And you know, a lot of times the software funds tend to lead, and people typically, they know SMH, like the semi sector, but the software sector is just as good. And if it, you know, John was talking about that before, it's like inside of that there might be Palantir, which was, you know, very much like now the biggest component of that software sector. Similarly, you know, NVIDIA is the biggest component of the SMH, the semiconductor space. But when you look inside, when you look underneath the hood of, let's say, the SMH sector, there's a lot of components there that have a lot of catching up to do. Like you might have one massive component of the SMH that's been outpacing everybody else. But all of a sudden you have this little AMD who's actually in the last 2 months, maybe, who's actually had an 80+% increase on equity, right? Just from $100 to today hitting 100, literally today hit $180 from $100 not that long ago. I mean, how many, a month ago? I mean, and that's outperformance. Inside of the software sector, we're seeing the same exact kind of setup right now, where we just witnessed Palantir go from $8 to $160, $150. We just witnessed Robinhood do very, very similar things. There's a lot of the same kind of opportunities underneath the hood, I think, in the IGV, in the software sector space as a whole today. But I think it takes a special skill set and maybe a special understanding of I think we're coming into probably a stock pickers market, but there are a lot of opportunities, albeit we are at all-time highs. I just think there's still a lot of opportunities where you don't have to go out. You don't necessarily have to buy NVIDIA at the highs. Not that it's a horrible thing necessarily. I don't really know, but there's still value to be had out in the market, I think is my point.
Yeah. Evan, you want to jump in or you want to go to John for thoughts first?
Let's go to John.
I mean, so the interesting thing about me is the problem with IGV and the problem with, I mean, look, I think there's like two like real software funds in the market. And like, you're like, wait, like IGV has or like Palantir and Oracle have a bigger weight than Microsoft and IGV. You're like, what in the world? How are they running this thing? So they're kind of weighting it off market cap, but they're kind of, you know, capping the weights at a certain point. And to me, it doesn't like necessarily make a lot of sense. The other problem with some of these funds, which while they're still good funds, is that like you don't get any Google, right? And like we all know Google's a software company. I'm like insulted that it's not in like information technology. It's like literally technology I use to find information. And so it's like, I don't know, the SEC can't convince me on that. But I don't know why it's in consumer discretionary. But I think the best thing about this is software is really a theme of automation, right? You use software to automate digital tasks. That's just what you use it for. And it can also, you know, it can get so well at that, it can automate physical tasks as well. So to me, like software spans much more than the software sector, which is why I have this software platform ETF, SOFL, because there really wasn't an ETF out there that could capture that. Like think about Visa, right? Like they automate financial payments. You don't have to like send a wire transfer every time you're going to the grocery store, or you have to like, pay with cash. And so they create just immense savings for their customers and everybody that uses them. Really what it is it's software connecting everything. It's a big software platform that provides financial services. And, think about like Robinhood is the same way. Like we know, like they're really a software company that's automating brokerage services. And then they're reducing the cost so much that they're able to provide these services at the best cost in the market to their users. And so software is really like, is quite a bit more spread out. But I think when people invest, you want to have the most diversification if you can capture all the upside. So like it makes sense to have this extra diversification in a fund. And I think that adds a lot of safety, and it doesn't actually dent the returns at all. I think it increases it because it gives a fund manager the ability to stay in the highest growth. And by the way, I include companies like AMD in this, like because AMD, NVIDIA, they build their software stack is like one of the competitive moats of their chip, right? That enables them to run specific tasks. I mean, AMD also has like field, it's called LPGA, not the golfers. LPGA, it's like basically it's like a chip that can act automatically without having to send it through the software code. So it's like software on the chip. And so the interesting thing about AMD, like obviously it's a top position of mine, is like the CPU business was shrinking, which is like the traditional chip for data centers, and the GPU business was like NVIDIA and AMD was taking all the business. Well, NVIDIA or AMD had both of them, so like it looked like they weren't growing at all for like a quarter. It's like the GPU growth, or for a year, was the GPU growth offset the CPU losses. Now this year, I think what's interesting is the CPU business is staying constant. At the same time, the GPU business is growing at like almost 60%, which is close to NVIDIA's growth rate. And it's trading at 1/3 the valuation metric. So all of a sudden, we're seeing this huge acceleration of revenue growth, which was like quite obvious to anybody that read the financials that this was going to happen. And so like now it's at 35%. It's going to keep trending upwards to like 50% plus. And it has 470% earnings growth or something ridiculous. And like, you're like, well, how much can they keep doing that? And you're like, well, like I know NVIDIA just grew their earnings by 18,000 or 1,800% in the last 2 years. And I'm going to bet AMD does the same thing once their GPU business kind of takes over and is a big dog. And now it is. So, I mean, I think that this is pretty much like where the innovation comes from in the market, this software platform sector. And like, at the same time, I think there's also like a lot of investors that are worried about the economy. Like over the last 3 years, like every day you hear like an economist, like the recession's coming any day now. And like, yet at the same time, like the NASDAQ 100 is up over 100% over 3 years. So it's like, there's a sector of this economy that's booming like never before. There have incredible earnings growth. And I kind of think it comes back to that software platform sector. And so this is a wonderful opportunity to put this ETF out there and be kind of like the first of its kind.
Yeah, the names are really interesting. I was curious, Paper, actually, to run some of these by you and get your thoughts on these top holdings. So just to kind of run through a couple of these, or I can just screen share them. Might make it easier for people to see, because I do think that these are a lot of the names that we're focused on right now when it comes to this. So NVIDIA, probably also due to just how much it's been surging, has moved up to over 7.5% weighting in here. Google almost 7%, Amazon almost 7%, Apple, Microsoft. So right up here, you could see a lot of the large cap tech making up the top, but then, Visa, Netflix, Oracle, MasterCard, and there's a bunch more. There's Palantir in here, and others. And this is inside SOFL for anyone watching that wants to take a look. Paper, turn it back over to you, kind of get your thoughts on this.
So SOFL specifically, so I'm just kind of learning this. SOFL is a 2x leverage on all of these, correct?
That's right.
So, I mean, so all these Visa, MasterCard, and payment processors, I get that. Help me understand. So if I'm looking at this objectively, they're about 4% each. So let's say 9% between Visa and MasterCard. And then you have about 7.5% on NVIDIA. Why would we split between Visa and MasterCard also? That's kind of curious. I like them both.
Yeah, so the interesting thing is like, so I did a lot of research, and like I'm really all about, like, I have all my own money in my own funds, right? So like I'm really about creating really good products for myself and for whoever else wants to buy them with me. And so like in my research, Jason and Gab, you guys probably know this, and I can share my screen. But like you guys know that, like I'll just share my screen, whatever.
Yeah,
Um,
you can. You're good to go for it.
yeah. So let's see. So uh, yeah. So like if I go to Morningstar, right? What you guys are gonna like. So in the over like the past 20 years, 5 years, 10 years, it's always the same story. Large cap, which is right here. Large cap always beats all the other caps, and growth always beats all the other style types, right? So large cap growth is the best historically. You also know that technology is the best historically. And I kind of tie that back to the highest proportion of low marginal cost names and all of these things. And then, so then, like, if these things have been done the best historically, and here's like another example, right? So, like, here's a screener, right? Sorted by the 10-year return, right? So, like, you'll notice what? What do you notice? It's all tech, right? Like, it doesn't matter whether you do 15 years or you do 20 years, you'll see that everything's all tech. Like that, those are like the best returns. And the annualized rates, I mean, like, come on, 20 something percent for 15 years in a row annualized. It's incredible. But there's room to improve upon these. Like in my research, what I was finding is that, and then here's the next one. So if you include the leveraged ETFs in it, so now this includes all ETFs, right? You'll notice actually that the leveraged technology is the best in the whole market. Like if any ETFs ever made, like look at that, 42% annualized for 15 years in a row. That's crazy. 39%, 39%, 32%, 30% annualized. I mean, we all wish we could have returns like this. And so, but at the same time, there's a problem when you invest in an index in that they only weight by market cap. And so what you should realize is that like we're just talking about, like AMD has 450% earnings growth, right? Like Microsoft, Google, like they're all great earnings growth. What if you include other factors in this, which is basically low marginal cost? That's a factor. What if you include profitability? Because like especially when you're in a leveraged fund, like a large part of a technology index might be unprofitable. And those are the ones that go down 80% plus in like a recession or whatever. So like, what if you don't include those because you don't really want to risk the chance of leveraging that on the downside? And what if you focus on some of the safest, bluest chip companies, like, but they keep that low marginal cost profitability, and you create a tool that could beat like the best ETFs ever made, right? And like my AOTG fund, which is unleveraged, is very similar to this. So I wanted to put out a leveraged version as well with a similar investment strategy to try to go toe to toe with some of these daily leveraged funds. And I don't know how much you guys know about the daily leveraged, but the pretty amazing thing about them is that like they buy on and as it's going up and they sell as it's going down. So if you target the sector strategically and you use it as the tool, like in the right way, that you can really compound upon the shares of the fund of like the holdings at the same time as you compound upon the investment results. So it's like taking something in calculus to the third power instead of the second, and that's how they're able to show some of these incredible gains. And SOFL is all about doing that.
Yeah, it's a fun look at history there. Jason, that answer your question?
Yeah, it does. So the individual equities, I guess, is there? What's the typical rotation? Like, how often do they?
Yeah, so there's a factor scoring, so they can change up to like quarterly, but at the end of the day, this is a more of a long-term buy and hold like index, right? So it's not high turnover. It's really about trying to get the sector right. Focus on the most profitable, most low marginal cost names, and not have a lot of turnover. So it is a passive index that it actually leverages. So this is the way most passive indexes work.
Evan, you want to jump in?
No, I think you were talking a lot about that there. I was curious more on the AMD side of it. That one's been going crazy recently. Also Oracle too is another one that I find a little bit interesting. That one has been pretty strong recently, and looks like it might be the next company to join the $1 trillion market cap club. It's still 200 billion away, but it's the one with the momentum right now. I don't know. I'm just messenger. We'll see. But those were two that when you were talking was interesting for me.
Yeah, I mean, what's really interesting is that NVIDIA doesn't want to only have like 3 customers and get pigeonholed. So like they don't want to be like, oh, we only sell to Amazon, Apple, and Google. And so they've really created these, and they've like kind of like seeded and allowed, like Oracle was kind of lagging behind, and now it's like back up on top. And you also see things like CoreWeave and stuff that almost like wouldn't have existed without the kiss of the blessing.
That's one question I would have. So like in your the setup here, it's like how many funds or how many equities do you typically hold
50.
in SFL? How many?
50.
50. So we just saw maybe 10.
Yeah, 10. I've got the whole list here. I tried to get it out to everybody actually before, but I don't know why. But like if you go to like TechL and ROM, like they're all like these are leveraged funds that leverage an index. You can't find like the full. I don't know exactly what the reason is behind this, but like these sites publish the top 10 holdings of the index like quarterly, and that's like the same way we're doing this. So I do have the whole list, and I'm sorry that didn't get to you before then, Jason.
No,
but as
fine.
you go down, like you're going to see like Salesforce and Intuit and ServiceNow and Adobe and things like that you don't see in the top 10.
Oh, okay, perfect. Yeah, that's kind of like where I was. That's where I would have gone. Is kind of like I think there's a huge opportunity in the basket of the smaller ones too right now. For
there
sure.
is. I agree.
There was a question. What happens to the dividend? I'm sure there's at least 1 or 2 names in here that pay. Maybe not a lot, but a couple. NVIDIA, 1 cent per share.
Yeah, so dividends do get distributed. Sometimes in tech funds, the dividends are a lot lower because the companies do buybacks instead, right? So like Google hardly has a dividend, but they're doing like $100 billion buyback. So the first part of dividends go towards like paying like the expense management, and then what hasn't covered the expense management then gets paid out, and that's like in any ETF, like whether it's like the Vanguard or whatever. So and then the dividends get paid out to the investors after that.
I have a question real quick, just on the leverage side, because leverage products typically lean towards more tradable products, right, than long-term holds. But when you look at this product, right, there's a lot of names in it that I'm like, okay, I do want to hold those long-term. I don't even mind having some leverage on them. How do you envision, retail investors approaching this, thinking about this, where it fits into a portfolio?
I mean, I think that you use this as a tool to magnify the upside, and obviously it magnifies the downside as well. So like if you like are bullish on the sector, like I guess it's about how it meets your investment objectives, right? And so like I think it's up to everybody to make their own decision, and like the investments are a judicious decision that people should like weigh the risks and understand. And but like for me, like myself, like I also own the other like TQQQ and TechL and ROM and QLD, and I hold those more as like longer term plays. And I think like I think it's just up to everybody. But like what I think is kind of interesting, like with a very small amount of your portfolio, right? Like it's not like you put your whole portfolio in something like this, but it has the opportunity to grow year over year and continue to compound. And like, yeah. I don't know, like the reason why I originally got interested in these in the start and then wanted to improve upon the existing ones is because like I did well, but I also realized that had I 2x leveraged AOTG, I would have done better than all the other ones. So I thought there was like an interesting opportunity there of taking the strategy of focusing on like that large cap technology growth, really like focusing on the profitability and things like that, and using that as a way to create really good returns. And like so like you could see like TechL, it's a wonderful, like I'm just going to pull up one that has a longer history than SOFL because SOFL just launched in July, but like you can see that if you get these things in a pullback, like, right? Like if you
can you try and zoom in a little on your screen if you can?
Let's see. So if you get these things in a pullback, like you can see that like there was a lot of people that were buying these things during the trade war. And I think the Wall Street Journal even like wrote an article about how dumb they all were. Like the people were doing that. And then like, of course, like these people put trillions or billions of dollars in these funds during like the trade war, and they made like a killing. These retail traders made billions together, and like now they're probably out there selling them. but some of them are going to keep holding them. And you can see, like, I don't know if you guys can do the math, but like, since this thing has started, it's up almost 31,000%. So if you had $10,000 in this thing when it started, and you rode it all the way up and down, all these up and downs, and you probably had some stomach churning moments, you made 3.1 million. Like that's like winning the lottery, 10,000 to 3.1 million. So there is like a very interesting mathematical concept to me, because I like the mathematics of these things, of like how do you use this as a tool, like to do just incredibly well. And then for me, when I make this fund, how do I limit some of the downside risk in these things by like kicking out the unprofitable companies and the sectors that are going to be sideways trading, and focusing on the longest term secular growth with the lowest amount of risk. So like, to me, like, I'm trying to make a better one than the existing ones, but man, the existing ones, like 10,000. If you like got married and you had a kid, right? And like that thing is what, like 18 years old, and you're like, oh, here, little girl, like here, I just had a baby daughter, here's $10,000 in your UMTA. You buy like that, go with it or something. And like she turns 18 and you're like, well, I wonder how much that is worth now. And you looked, it was like 3.1 million. You're like, what in the world? Like, what in the world? I can't believe that possibly did that well. So history is like, past performance is not like indicative of future performance. But what I would say is that like these things are like, I think they're fun, and everybody should understand the risks. But I think that like they're incredibly powerful to long-term daily compound and daily leverage a sector like U.S. technology, which is like the best in the whole world. These companies don't have any debt themselves already, so it's not like you're like 2x leveraging a 5x leveraged like steel company or something. Right. So in some ways, like this is even less leveraged than like a lot of S&P 500 companies already have. And the other thing about this is that like those companies that are leveraged can't like daily compound in the same way. And like an ETF can usually like have lower borrowing costs also. And there are some like wealthier people that like invest in private equity. And this is like the craziest thing to me. Like these private equity companies are like 3x leveraged, their funds, and like they go buy like Joe's Crab Shacks or whatever, and like they pediatric dental practices, and Harvard and like whatever, Yale are like, oh my gosh, here's like $35 billion to do this with. And their returns are like 6% a year or something. And like they're paying 2 and 20% fees. Like, and yet you have these other ETFs that after fees are returning like 40% annualized. They're applying less leverage, and they make like 8 times more or something. So it's like this could be like the future of leveraged investing that's tax efficient, that has better returns. And by the way, like leveraging Microsoft, Nvidia, Google, whatever, like that's safer than like 3x leveraging Joe's Crab Shack. So like, to me, like I kind of wonder, like, is the rest of the institutional market one day going to wake up to these strategies being better than the ones they deploy? The problem is you see them daily, right? So like you can't be like a private equity fund. You're like, oh, well, I don't know what happened last quarter. We're not marking anything down, like during the trade war. So like they are very visible, but like if you were in a private equity fund that just minted and you go to withdraw your money like a quarter like later, your 3x leverage, like they'd be like, well, we're bankrupt. Like you can't withdraw. That's why they have a 5-year lockup. So like I think that all these things are interesting, and like I hope other people like these daily leveraged ETFs like I do, because I have a lot of fun with them.
First off, I was just going to shout out to Jason's crew is in the chat. Man, they are here. We're getting a lot of comments, so shout out to everyone in the chat.
You guys know somebody named Steve?
Like froze.
I look like young Steve.
This was good. Do you see this one, John?
Yeah, Steve is a regular on Amit. Steve is a regular on Amit's show.
Jobs, like, I'm not bald.
This one's good for you. This one's good for you.
I can't see them anymore.
Oh, he said, Jason W said, for some reason I don't like fund managers, but this guy seems trustworthy.
Yeah, well, I'm right there with
I actually wait. I want
New York are a little sketchy, but I'm in Iowa, so we get by being honest.
I want to ask you though. One, we did get a question around the fees and the ticker SOFL and the fees. It's on the website. It says a 1.29% expense ratio. This is a leverage product that tends to be where it's around. So I would love to first hear like why those leverage products kind of sit around that place, and like what's in that fee. And then also you were kind of talking about you investing a lot of your money in this. And one thing that I hear a lot of people talk about is wanting to create ETFs for themselves. for like the tax benefits or the other benefits that it has into it. I was curious more of kind of like the reason why you even launched these ETFs, if that was kind of the direction.
So I was investing like in SMAs like before this, which is a separately managed account. That's like financial. That's a good comment. All right. But basically, like if you're in an ETF, like I can turn over a portfolio like an AOTG and sell NVIDIA and buy Microsoft or whatever. That doesn't recognize a capital gain. So like the tax efficiency there, Evan, is that you don't have to pay capital gains ever, even when you sell and buy stuff, which is untrue in mutual funds and it's untrue in your personal account. Like if you sell NVIDIA for 1,000% gain, you're going to turn around and give a half or a third of that to the U.S. government or more, and then like
or more.
Yeah, or because, unless you like live in Puerto Rico, like and then you don't give as much. But so yeah. So basically, like there's like a thing like where like if you're saving millions of dollars on taxes like that way, that also stays in the market for like as long as you want. So like if you're not selling the ETF, it could stay in the fund for another 30 years and compound every year for 30 years. So like that $1 or $2 million you're saving in taxes could become way more. Now, obviously, like you need to have enough savings because ETFs are expensive to start and run. And so like, and then when you do a leveraged ETF, you have higher insurance costs. It's harder to get the leverage and there's more costs involved in that. So you have a higher expense ratio again on leverage ETFs versus a normal ETF. And so like the cheapest sort of ETF is obviously going to be like a Vanguard one where like they have like trillions of assets, but like the person, as someone starting an ETF, like for their own, first of all, their ideas are, they're starting something, or I'm starting something, maybe not everybody, but because I believe like the Vanguard ones can't do it for me, right? So like in AOTG, right? Like I think it traded at 53 today. It's 3 years old, and it's launched in like the 24s. So you guys can do the math, but it's like over 120% plus, like in 3 years. The S&P 500 at the same time is up like 65 or something percent. So like you're talking about like over or doubling or close to doubling in 3 years, and that extra 60 percentage points, like even if it's not a lot of money, it's a lot. Like at the end of the day, that it makes sense. So like AOTG and like these are mostly like like I had said I have like all my money in them, but I also like because I like daily leverage ETFs, I thought I could make a better one for myself and for other people. So we'll see, and hopefully like it takes to the market and it's a big ETF. There are no other leveraged software funds in the market, and I think like the software platform sector is a better way like to play software in the first place as well. So hopefully that answered like some of those questions.
Yeah, I appreciate you. Paper, I want to throw another question your way. First of all, every single time you come on here, John even commented before, awesome background. This guy's got the spaceship there. I love it. I want to get your thoughts on these leverage stocks and ETFs and all that stuff there. And do you trade them? How do you trade them? Is it something you put in your lawn? I'm just curious on how/if you use these.
I definitely trade them. Definitely trade. Well, truth be told, I have a couple accounts that I was. So initially what happened, so I used TOS and I got flagged as a professional trader a while ago. And back in the day, they called me and said, look, dude, you're not allowed to trade anymore on the regular platform because you're now whatever. You've traded too much, essentially. And so I had to trade them for a while. Because like John, actually, I don't mind them. I'm an options trader. And I'm a very active trader. I'm really not a day trader so much. People think I'm a day trader. My background is swing trading. I'm pretty advanced trader when it comes to options in terms of like volatility and things like that. But overall swing trading, like multiple at my core, I really enjoy looking at the overall kind of like blending my macro fundamentals views and some kind of sentimental thesis along with the technicals and blending all three of those together, technical analysis, fundamental analysis, and sentiment analysis in the current market scenario, which is like these three things together can give me at times somewhere between a 3 to 9 month trade sometimes. If it's really good, that's actually ideal. And I could, if you can find a 3 to 9 month trade, that's beautiful for a leverage ETF. It's not typical, but otherwise, if you can get even one couple weeks at a time on a leverage ETF, you can get really good moves on those. And we will use those quite often for that. I say we. Sorry. So I run a trading group, of course. But yeah, a lot of our traders use leverage ETFs quite a bit. The regular stuff, TSLT, leverage Tesla, leverage.
In what scenarios would you use a leveraged one over a regular one? Do you like? You're an options guy. Why would you go in and use this? Are you using options on the 2x ones too?
No,
The
never
paper
options
gains?
on leverage. No, never. Like I said, I'm a volatility guy, so I'll tell you right now, if you want to try to trade options on leverage ETFs, there's no point because one, the bid-ask spreads are double, triple, and two, you're paying twice as much volatility anyway, so you might as well save on the spreads and just pay 1x volatility. You're not doing yourself any favors by using options on leverage ETFs. But I would use leverage ETFs, let's say sometimes for earnings, if I wanted to sidestep volatility and use something like that. Sometimes it's just easier. There are times when leverage tickers are better because you can't trade options during certain market hours, especially in like the pre-market or after hours. Those will trade if they're liquid enough. But yeah, the baskets of stocks for sure. Definitely, if it's just easier to manage sometimes. Yeah.
Yeah, I can touch on it. So basically, like, if you were like, so, Paper's like a professional trader. I don't know what you can get margin at, but like a lot of people, like you're doing it on Thinkorswim or something, like even somewhat people that are like somewhat professional, they're still being charged like a 12, 13% margin rate, right? So an ETF can borrow closer to like the federal funds, like 4.2. So,
What? Yeah.
No, seriously, like go look at like what Thinkorswim charges and like what some of these things charge. They charge like 13%. So like first of all, like an ETF can borrow in the long run like that, they're saving like 7 or 8% a year. You even subtract the fee off, like the management fee, and you're still saving like 7%. So like I think there's like a pretty interesting thing there. The other thing, if you trade on margin, remember, like if the market drops 50% or something and you're 2x leveraged on margin and you're not managing that position, you lose everything. So now an ETF is selling every day on the way down to manage the risk. It's also buying every day on the way up. So basically, like it'll sell on the way down, boop, 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 and then it buys on the uptick. Boop, 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 boop. So it's like a really like good way to professionally manage risk. And so I think like for the typical retail trader, this involves less like management and less risk for them, lower cost to leverage, and so I think like it's like a good option for them to have in their toolbook to be able to play the market the way they want. That's why I use them instead of like did it myself, like on margin, right? Like personally.
Yeah, it makes sense to me. Jason?
No, I was just gonna say too, especially if you're starting out, what I can say too is, especially for an early trader, and we have a lot of these in our groups. I'm not like I like to think I'm fairly young, but we have a lot of younger traders like that come to us in our group as well. And so sometimes they really want to be super diversified because they come into the market, especially a younger generation. They'll come into the market and they'll come from a place where like they're trying to learn and they're getting taught by a lot of older generations, which are coming from a place of like, oh, be diversified, because an older generation is like, they need to be diversified. But the fact is, at a young generation, as a younger investor, over diversification is, first of all, it's very complicated to manage, and second of all, it's not always the best thing. That's for survival. Like when they're young, honestly, too much diversification is not, it's not that great, right? Because they're more in their earning years, right, where they can take some more risk. But to have a basket or one or two baskets of diversification that does it for them, that's ideal. And then have like a handful of stocks that they can like follow very closely, 3 to 5 very like I'm very intimately aware of. Let's say it's Palantir, it's Robinhood, maybe they like hymns, maybe they like whatever, and they're gonna follow intimately, listen to every earnings report, and stick with their horses, from cradle to grave. I've been in Robinhood since 8. I've been in Palantir since 8. I've been in him since 8. Whatever, and I can ride this horse. I don't know, Gav, what was that oil stock that you liked? It was
Oh
Vista,
my gosh.
Vista Energy. This guy
Oh.
picked Vista Energy at like $3. It's $30 now. He's still riding it. I don't know what's going on, but
We still going?
I don't know if it is or isn't. But anyway,
Okay. It's kind of been chilling since like June, but yeah, of
my
last year.
point is that if Gav were to stick to it and follow it closely, he would then learn how stocks really work a little bit better anyways in his journey in the stock market. And I think that would probably serve him better, while another fund, leveraged or not, regardless, could manage that diversification for him.
Yeah, I mean, leveraged funds are always going to come with risk. And Jason, Jason, do you prefer paper or Jason? I'm trying to figure this out.
Oh, it doesn't. We're on stream. You can call me
So-
Jason. It's fine.
So
The guys call me paper. So
I mean, I was a professional market maker in a prop shop. Yeah, I was a professional market maker in a prop shop, and I've seen like a lot of people blow out with leverage, right? So I've seen a lot of people do it in their personal accounts. Leverage is risky, and it needs to be managed daily, and that's what these ETFs do. Like obviously, you shouldn't be putting all your money in a leverage thing, or even close, or not even like a big minority of it, right? So like that's just like a fact. Like the guy I used to work with was trading natural gas leverage in Chicago, and like I think he blew out and he committed suicide. So like there's like a human, it's really sad, but there's like a human nature to double down when it's dropping. And so like if you're trading and you're 2x leveraged on margin and something drops by 30%, and then you buy, you're not just like 2x leverage anymore. Now you're like 20x leveraged, right? You lost a bunch and you bought more. And so like you have so like imagine like you've got $100 from the bank and $100 lent. And so now it's only like $50 from the bank, or $50 of equity, because it drops, 25%. And then you go double down and you get another $200 from the bank. And now or $100 from the bank. So now you have $200 from the bank, but only $25 of equity. You're coming up on 10x leverage, and the market just drops a little bit more and you're gone. And sometimes like the margins aren't even there to cover you on these things, and like you owe the people money, like more than you had to lose. Like you can't like lose more than you have, one, in a leveraged ETF, two, like 2x leverage. Technically, if the market falls 50%, like you're gone, but like you don't lose any more than that. But the other thing is like the market shuts down after 20% down, right? So like then there's a trading halt and like you're done for the day. So like I don't know, like technically it's possible. I think it would be like extremely unlikely to be down 50% in a day. And like you can see the history of these other ones, even the 3x ones are very good. So 2x is less leverage than the 3x, and I think I can afford to take less risk and actually get better results the way I have custom engineered this passive index, which is the way I'm doing that. But it is like something risky, and trading on margin is very risky if you're not going to manage it and you're going to double down instead on the move. So like I don't know, for everybody out there that's just getting started, don't ever do that, because it was sad to see my friend not be with us today.
Good lessons for those that are taking a look at margin, leverage, just different types of trading tools. I really enjoyed this. I think there was a lot of good takeaways from it. Jason, did you have any other thoughts or paper on the use of leverage in pieces like that?
No, I think that's all
well covered.
Yeah, absolutely. I think the leverage topic in general, I think it generally, it's maybe slightly misunderstood, but absolutely to be dealt with, better to be dealt with by a professional for sure. That's no question.
Understood. Okay, perfect. Yeah, I was just looking back through just some of the holdings here as we continue to get interested. I thought it was curious that the ones that you pointed out, paper were the payment processing ones.
Well,
You
only
know,
'cause those were the from the screenshot that we saw at the top.
yeah,
But
those are in the top 10.
yeah, I think John taking a tact or a strategy of specifically that software. So the tact or the strategy, if you will, of the fund, calling it software. I think maybe just like one more to end with the beginning, if you will, like of the fund, like the strategy, like the companies that you're putting in the basket, their software plays overall, right? Like
Right.
what they do is like their platform. We'll call it a platform play, if you will.
Yeah,
Like
software
Robinhood
platform, right.
at its core is a platform play. Microsoft is a platform play in terms of like they have their own ecosystems within them
Yeah.
that are built
Yeah,
on.
and I think like the thing about a platform, Jason, and this is kind of like the new rise of software, is like you're not
Right.
seeing as much at SaaS. Okay. I
Right.
think what we see now is the rise of the digital toll booth. Okay. So the digital toll booth is a software company like Visa, even Apple with their App Store, Amazon, they take a cut of every transaction running through the platform. So like whether it's like so I mean you guys can think of a million like this, whether it's like a company like Etsy or it's like even a company like Robinhood. They're taking cuts of the transactions running through, and that's how they're making their money. Even like Paylocity payroll software, they're making it from putting the payroll stuff in like the money market funds and taking a cut of those earnings, or 100% cut of the money market earnings. So like I think like this is like the rise of software being free for people, and which is really good. And then they monetize it in a different way, just like Google search is free. And so they're true software companies because their core business is software development. They just maybe aren't classified in the GICS classification as that typical SaaS, company that makes it from a subscription. Yeah, Shopify up in the comments. And then there's another question in the comments about NAV destruction, right? And so I think what they're talking about is volatility decay. So like these funds buy on the up days and they sell on the down days, right? So I think that's like what makes them so powerful, because you're buying on the up days, you're amplifying the upside. And in the long run, you're going to want more than 2x if the sector goes up. You could like TechL, like you could 30x, right? The like the underlying index, in the very long run. But then like in the downside, if the market drops, 50%, but because it's always going down, you might only lose like 70% or something. And you can look at some of these like ROM or TechL and see how they did over those time versus the underlying index. But it protects you on the downside. It amplifies the upside and it helps you take off the risk to manage risks, but put it right back on as you're going up. Now the downside of that is NAV destruction, right? So NAV destruction in a sideways trading market, and I don't think NAV destruction is like a good word for it, but in a sideways trading market, imagine the market's at 100. It goes from 101 to 99. It just does that every day all year long, for the whole year. So it buys every day at 101 and it sells every day at 99. Well, you guys know where that's going. You're buying high, selling low. So over time, you could erode 5-10% of the value of the fund doing that. Now, that's like why you don't want to like leverage a mean reverting index. So like imagine you have like you want to leverage like oil companies or something. So like the price is high when oil goes up, and then it's low when the oil goes down. It goes back and forth. So that mean reversion is where you get a lot of NAV destruction. In an upward trending market, like say like US tech, you look at the long run and it's generally like a straight line up. That's where you don't get NAV destruction. That's where you get the leverage amplification, of amplifying that upside through compounding the share exposure and like the underlying shares being worth more at the same time. So I think that's like a way to play this in a way that's safe. And it's the element, like there is no free lunch. That's like the sacrifice you make of having that risk. But like if you think that tech isn't going to trade sideways and you're bullish on the sector, like that doesn't change. That shouldn't be something that, scares you away. It should be a risk that you understand though.
Yeah, I think that when they think about stuff like that, I'm trying to think of one that's similar. Okay, so LabU, there's one that everybody looks at and they think of. I don't know if you know LabU. That's a 3x leverage biotech ETF. It's 3x, but it's
profitable companies. That's all I want to
say.
say.
Yeah. So it's IVB, and that's what they think of when they say stuff like that. It's IVB, the biotech. It's biotech, yeah. Has gone sideways forever, for I don't know how many years. Yeah, about 10 years. About 10 years, it's gone sideways, and there are leverage ETFs, and I think that's the biggest concern. So
Yeah.
what John's talking about is exactly that, right? So when something is going sideways for that long, yeah, the leverage ETFs will have to split over and over just to stay listed. But that's worst case scenario. You don't want to be in a leverage ticker in that kind of scenario.
Yeah. Really good thoughts, guys. I'd love to keep this going. And to be honest, we got to do another one of these and just take questions from the chat because they are coming in hot. I see Qualcomm conversations going on in there. I know there were some conversations around PLTR and a couple of other CRM. So a lot of good stuff going on there. Shout out to the paper crew where I know a lot of them are coming from and hanging out. Let's just do some final comments to wrap this one up. Jason, anything else you'd like to cover on this one?
No, I think if you can post in the comments, and then I'll retweet wherever you post it, the full list of John's current holdings and where they can, and I'll get it pinned to our YouTube, and where they can see that updated list, because I know any viewers are going to be able to. They're going to be curious, John, of like where they can see that updated list.
Yeah.
Because I know for us right now, we're very much in the. It's not. I wouldn't say deep value, but where a lot of people are in the market is that if we're going to continue to somehow we do continuously float to new all-time highs, where is it going to come from? And it might be in this software sector. And to have a fund that maybe is able to manage that for them would be possibly at a leverage rate would be something worth looking into. So having a source that could possibly be something that could help with that would be ideal. And having the resources to be able to sift through that's what they would be looking. That's what people I think would be interested in right now.
Awesome.
Yeah, love it. John, any other final comments from yourself?
Yeah, no, I just I'm trying to throw up the.
Yeah, and then if you could drop.
Right. I was like, why didn't I do this earlier? Why didn't I just
in the comments?
Just email that to me. Yeah.
Yeah, I'll shoot it to you, Gab, or attach it in the comments, right?
Yeah, drop it in the comments and then highlight it real quick, just the website and where they can follow them. And then, John, if you have a Twitter or something, so they can follow you and pin you.
All right. Well, it's been good, guys. Appreciate it today.
You got a logo question, AOTG logo. Let's pull it up.
Oh yeah, no, I had a designer come up with it here in Iowa, so it's good. I mean, I kind of. There's a lot of good like logos in this industry, so you can look at like a lot of companies. But I came up with AOT because I wanted it to be A at the front of at this front of stuff.
Oh, you should next time do AA. Apple.
Yeah, there's other companies in
Big
front of
company.
me that are like 21 shares and stuff. Can't believe it.
Oh, okay. Wait, so does one go in front of two? Is that how it works, or is it just numbers all in random places?
For the logo, it's AOT, right? So,
Okay, here we go.
Yeah.
Nice.
Someone said new all-time highs as long as we take Trump's phone away. Nice.
The interesting thing is that like he's defending American companies abroad. Like he is going and being like, buy their products, support them, stop prosecuting tech companies, stop giving them all these fines and stuff. It's really playing to the tech. The tech was getting pretty badly beaten up during the Biden administration with all these fines, and they had to censor speech, and it was turning a lot of people off of it. So I think that this is. I think that the developments have been pretty positive, really, in this administration for tech, and they've been just rigorously defended against. And now you can see most of them have come to his defense, Trump, and you see them all with him because they realize this guy has their back.
Love it. This one?
Nope. I appreciate you all.
Very cool. All right. Thanks so much to everyone for tuning in. This was a fun hour. I like the takeaways here on everything that we talked about with software For those that missed it earlier, we talked about mainly SOFL ETF. If you want to take a look at AOTG, one does have more track record as well. You can check out, like John mentioned, pretty much doubled the performance of SPY over the last 3 years. So go check it out. We tried to take as many questions as we could. We'll do another one of these at some point and take some more questions. Evan is going to go live on the space here in 1 minute. If anyone wants to jump in, there's going to be a space show. And then we're actually going to be live again on the live stream back again at 6:15 p.m. Eastern tonight. So you can catch us there as well. Thanks so much, everyone, for tuning in. Make sure that you're hopping into Papers Disc, more questions. Check that all out. Give everyone a follow.